Hello, I'm Michael Hainsworth.
And I'm Peter Hall. I'm Senior Advisor to Elevate Export Finance, and I'm also CEO of Econosphere Inc.
The storied Silicon Valley Bank, the financial lifeline to so many startups in the United States since 1983, was shut down last week by U.S. regulators who seized its assets. It's the biggest U.S. bank failure since the financial crisis of 2008. Shortly after, authorities also took over Signature Bank in New York. Both SVB and Signature specialize in a sector whose asset values come under pressure in a rising interest rate environment. But what happened? What are the implications for Canada? And where do the tech bros of California and Canada now go for financing? Peter joins us for his insight. Peter, thank you.
Great to be with you again, Michael.
Let's begin by talking about the connection between interest rates and SVB. And tell me if I understand this correctly. The cash generated by SVB clients didn't go into the safety of T-bills because interest rate increases made the rate of return negligible. So SVB pumped its deposits into mortgage-backed securities. But the startups also suffered from high interest rates and started withdrawing cash to fund their operations, shrinking SVB's deposit base and forcing the bank to liquidate interest rate-sensitive assets at a loss. Is that fair to say?
Roughly speaking, yes, Michael. Basically what happened was, due to its own success, those deposits at Silicon Valley Bank swelled greatly. And what they did was a classic assumption exercise here. So what does that mean? Okay, well, if interest rates are going to be low for a long period of time, one of the places that you can put that cash in order to get a higher return is longer dated bonds. And if you put them into government bonds, well, most people would say that that was one of the safest things you could possibly do. It is safe until interest rates start to rise. Now, let's remember, nobody was expecting interest rates to rise, even negligibly, but to actually have these amazing 100 basis point, 75 basis point increases was not on anybody's radar screen. And in fact, central bank leaders had led everybody to believe that this was not necessary because the rises in inflation were temporary. They were going to be able to talk that back down. And that was backed up by 31 years worth of very stable inflation. Well, that all unraveled. The interest rates went up, and then Silicon Valley Bank and others that did the same were caught because, of course, when the interest rates rise, the value of those bonds drops. And, of course, depositors see interest rates rising and they say, well, I want a greater return on my deposits. And banks have to oblige, or they lose money to other banks. Well, then you get caught in a squeeze. You're paying more for the deposits, and your assets, those long-dated bonds, have actually gone down in value. This is where the problem started to arise. The ratings agencies moved in and started to question the value of the bonds of the bank.
Eric Regularly in the Globe and Mail states that the collapse exposed the epically bad management and risk-taking skills of the bros who ran the bank into the ground. Is this accurate?
Well, I think that's maybe strong language. Let's remember that in the United States, unlike in Canada, there are pools of capital that are made available to those on the higher end of the risk spectrum. That's a great feature of the U.S. market, the deep capital market, the desire to take on risk, and of course, the deep venture capital market. It all comes together to fund the very dynamic and research-oriented part of the U.S. economy that make it so innovative and make it so productive. Okay, so that's the good side of things. You know, when you actually go to the flip side, when you are taking on greater risk, there is a greater need for the risk management of that. And that was a lesson that was learned back in 2008. And so we got tighter legislation, Dodd-Frank legislation, that some decried as being anti-competitive and anti-jobs and so forth. But that is needed when you have a higher risk spectrum. And you regret not having that kind of regulation when something like this actually happens. And so really, you know, this is about appropriate risk management, as you said, And of course, all the questions are out there about whether the risk management surrounding this was appropriate or not.
You mentioned 2008, and I described this as the biggest bank failure since the 2008 financial crisis. Is SVB an interest rate canary in the financial coal mine?
Well, this is when, you have your greatest worry. If you can have a bank run these days, after all the decades of legislation that have been put in, literally since the Great Depression, and the liquidity crisis, the horrible liquidity crisis that we experienced, or that was experienced back then, if after all of that regulation we are still having bank runs, then of course regular people out there with deposits in institutions are antenna up on, hey, am I at risk as well? And so that's something that, of course, central banks and anybody that's into financial regulation wants to stem as quickly as possible. And that's why, of course, you see this action that happens with SVB very quickly last Friday, then over the weekend, Signature, and then, of course, as others have popped up onto the radar screen, Credit Suisse being perhaps the largest of those, you see officials moving in and saying, okay, we've got to do something about this. We've got to stem any sort of sense that there is a systemic issue that's going on here. Now, what I would say is that the regulations that were put into place back in the post-2008 world because of that financial crisis have shored our financial system up so that we do not have the same kinds of domino effects that we experienced at that point in time. But one can't actually control public perception around all of this. So it's imperative to move into this and to isolate, to ring fence the problem into a very narrow corridor of the global financial system. And if that can be done effectively, then we're okay. Now, back to your question. It's always the case when we have a sudden increase in interest rates and an inversion of the yield curve that the banking sector in general is going to have some difficulties, because generally the model is borrow short, lend long, and then you play off of the yield curve. And if that isn't any longer possible, then of course the questions start to be asked about the veracity of different institutions. Now, we have a situation where expectations of where interest rates are going to go are likely enough to calm the fears of those out there. Monetary policy will be effective. Inflation is already showing a marked attenuation. So the success is there, and there is expectation that there will either be flattening of interest rates where they are right now, or even interest rate reductions. And that seems to be enough at this point in time to calm the fears of many out there.
I still don't fully understand how we got to this place in the first place, because when it comes to backstopping deposits, I thought we learned from the 2008 crisis about the importance of stress tests. Or was that just a Canadian thing?
Well, legislation was put into place. In the interim, legislation was questioned. So stateside, some of that legislation was rolled back. And so it was deemed at the time that any financial institution that had assets of over $50 billion should actually have oversight, annual oversight by the Federal Reserve System, in order to determine whether risk management was appropriate inside of the institution. That legislation was rolled back and the thresholds were higher, creating a situation where you could have an institution with 100 or 200 billion worth of assets actually flying under the radar screen again to some extent. And so the legislation was put into place precisely to prevent an institution of SVB's size going through something like this without that annual oversight, to make sure that assets and liabilities were being appropriately matched inside of the system. So that's what you get.
You mentioned Credit Suisse just secured, a 54 billion euro bailout. Mismanagement appears to be a common theme between these two banks. Are these two major headlines a precursor to a global recession?
Well, that's a great question. I mean, really, if what this ends up doing is causing banks to actually tighten the credit that they're offering inside of the marketplace more than is appropriate to the original change in monetary policy that was actually occurring. So let's face it, the point of the monetary policy was to roll back the easy liquidity that had been made available for an extraordinarily long period of time. One does not want the market out there to get so used to low interest rates that changing that, going back to what's commonly referred to as a neutral rate, is an extremely painful exercise. I'm sure many looked over their shoulders and said, well, Japan has sort of been there for 35 plus years. Are we in the classic liquidity trap situation? Can we actually expect that interest rates are going to be low for a very long period of time? On comes inflation, and the remedy for inflation is still the same as it has ever been. The playbook is very well worked out there. Interest rates go up, and all of a sudden we're back into a situation where we backed ourselves into a situation where very aggressive interest rate increases were needed. That caught everybody by surprise. And of course, all the word out there is about recession. It really is all about the preconditions of the market going into that. My express opinion is that markets in the European area, also in the United States, were very well balanced. I'm talking not about financial markets per se, but the fundamentals of regular GDP in good shape going into all of this, not a bubble economy. And so if that's the case, you can actually increase interest rates, get up to that neutral rate. One would hope that it was at a more measured pace, but, conditions required this kind of drastic action. One would hope you get up to the neutral rate and the economy can handle it because it's fundamentally well balanced. So time will tell. There is no necessary recession here, but if financial institutions get to the point where they say, well, look, we have to tighten liquidity more than we were going to, just as a safeguard, then the probability of an economy slowing down more than otherwise would have been the case is definitely now on the table.
The corridor between Toronto and Waterloo is often called Silicon Valley North. So what are the implications for Canada's tech sector?
Well, anytime you have the financial sector dealing with something like this around the edges, where the riskier part of lending is actually compromised, or there is at least a worry of it being compromised, then those who are sort of out there in the risky part of the marketplace, and why is high tech risky? Well, you have these very long lead times of research and development where there's a lot of cash burn and there's need for working capital over that period of time. You don't have any revenue, you don't have a product, you're crunching towards a deadline, you're trying to generate cash flow. All of a sudden you do, and there's payback for all of those loans and all of that working capital you've had over time. So that's sort of the way the market works, and that's a very cursory description of it. When there's nervousness in the marketplace, when there's less capital available for everybody who's on that riskier end of the spectrum, things are going to be tighter. The inclination of financial institutions to provide capital to them, those are going to tighten up. And so that's a shame for those who are caught in the middle of a situation, and economic cycles really weren't something that they were planning for. But that comes along, the tightening actually happens, and there is a bit of a squeeze that happens there. Now, the access to that kind of capital in Canada has always been a bit harder than stateside. Our financial institutions here are more prudent. The depth of the venture capital market in Canada is nowhere near what it is stateside. And so our institutions, our tech investors are far more used to a tight situation. Maybe that comes in a little bit handier at a moment like this. I would say definitely stateside, though, where they're used to those deep pools of capital. If there's a retraction that's actually happening, then they will feel greater relative pain at this point.
For the purposes of disclosure, I have a relationship with a Canadian version of SVB. CIBC Innovation Banking is sort of the Canadian version of that down in the United States. And one of the things that they always talked to me about was that one of their abilities to get a client to sign on the dotted line in the startup world was, you may not know us, but we're Canadian and we're boring And we have a very different banking system. We're safe. You can trust us. I'm wondering if there is an opportunity for Canada's banking sector in light of what we're seeing in California today.
Anytime there's a downturn in the economy and you have more prudently managed organizations, well, the sun is going to rise on them, because clearly their depositors are going to be less inclined to get nervous. And of course, everybody's going to be going to them to ask them, okay, how is it that you managed your situation here? Can we actually learn from your risk management practices? Can we learn from Canadian regulation? Of course, back in 2008, everybody was lining up to find out what Canadian institutions were actually doing. And Canadians, prominent Canadians, were actually sitting on the boards of those that were discussing and then implementing regulatory changes worldwide to make sure that this wouldn't happen again. So clearly, there is capital, no pun intended, inside of the way that things are managed more prudently on Canada's side, and that's been proven in the past. And whereas, there are complaints during the good times that the banks aren't opening the vault up as much as others are, there is a smoothness, I guess, that comes from those management practices when the chips are down.
You've got extensive experience in the export side of Canada's economy. So outside of the financial services sector, is there an opportunity for Canadian companies generally looking south of the border right now?
Well, absolutely. I mean, I think that given the stronger U.S. fundamentals, this is the time actually for Canadian exporters to shine. So there may be a banking debacle that's actually going on, but it's those strong fundamentals that are leading forecasters all over the place, including the IMF, to revise up their U.S. forecasts. And of course, as the U.S. is an engine economy for the rest of the world, this is a very good thing. Now, having said all that I have about, the banking situation, the relative banking situation on either side of the border, one thing that Canadian banks have to watch out for at the moment is our domestic weakness. Our debt-to-income ratios, and this is consumer debt to income, here in Canada are far greater than they are down in the U.S. So if we're trying to superimpose a 2008 kind of picture on U.S. banks, and there's this panic moment in our minds about what's going on south of the border, let's remember that the consumer south of the border is nothing like the consumer back in 2007, 2008. Debt ratios have gone down from 150% of income to 100% of income. At the same time, we've gone up from 150% to 185. So there's a giant gulf between Canada and the U.S. in terms of our consumer debt situation. Most of that is mortgage debt in Canada. We know where house prices are going at the moment. So we've got a softening that's happening up here that actually puts more pressure or more of the spotlight on Canadian exporters, because they will be the mainstay of the Canadian economy, I believe, going through the next few years.
So encouraging news for Canadian exporters, but at the same time, it sounds like what you've just told me is that when the U.S. sneezes, Canada catches the cold, that we are at risk here in this country for a contagion as to what we're seeing in the U.S. banking sector right now.
No, that's not what I'm saying, actually. There is an issue that's going on in U.S. banking at the moment. As far as we can tell right now, it is contained. And what will support a banking system more than anything is really a fundamentally sound demand situation south of the border. The reason that it hasn't been able to realize all of that pent-up demand is because of the supply constraints that the global economy and the U.S. economy in particular have faced. So I would say, that the best safeguard for a banking system that is trying to deal with yield curve inversion, interest rate increases that weren't expected, and so forth, is solid demand. And I would certainly stake my reputation on there being very solid demand in the housing market in the United States, in the consumer market, and of course, by extension, in business investment. I'm quite bullish on things. I'm at the top end of the consensus spectrum for U.S. forecasts, have been for quite a while. And if anything is going to get them through a rough banking situation, that's the kind of thing that will. Now, remember, in 2008, there was a massive bubble that had accumulated for somewhere between 5 and 7 years. So it was a bubble of untold proportions, and that bubble was exported all around the world. So when we had a financial crisis, the economic fundamentals did not support it. So the two things came together. That's why I call it not just a financial crisis, but a financial and economic crisis. That was then. That is not the case now.
SVB was the banking partner for nearly half of U.S. venture-backed tech and healthcare companies on the stock markets last year. While its bond and equity holders have been wiped out, deposits, as we sort of intimated, there remain. The bank insists the U.S. government backstop makes it now the safest bank in the United States. Will the innovation economy trust SVB again? Where does the money come from to fuel the sector now?
Well, that's a good question, because clearly that, what happens in a situation like this is that all similarly structured banks come under the microscope. And if that is the case, the tendency would be, and it's far too early to tell right now, I'm just using intuition at this point in time, but the tendency would be to take a much closer look at their books and to, when they're making current credit decisions, whether that's, a continuation, a rollover, or an initiation of a new transaction, that's going to be examined a whole lot more carefully in light of the situation at the moment. That's only to be expected. And so as I said before, when you get into a situation like this, and when that credit tightening generally from a number of different sources starts to happen, it does become more difficult for those who are in the tech and in the higher risk spectrum areas of lending. It's just going to be a rough patch for them until we get through this.
So if the U.S. Congress and the country's regulators have an opportunity to make their financial system safer, where do they start?
Well, the rhetoric is already starting around the rollback to some of the Dodd-Frank and other legislation that followed in the wake of the global financial crisis. So that's the first thing that's going to come under the radar screen. It's really, okay, did we have the legislation in place already that would have either averted or attenuated what is happening right now? So that's number one. And the second then wave, I guess, of examination would be, were those legislative safeguards in place? Would that have been enough? Or do we actually need to examine, where there are still existing cracks inside of the system? So I would sort of view it as a two-stage thing. And I think, as far as I can tell right now, the legislative rhetoric is more around, did we really need to do that? Did we need to roll back that legislation? Was that really the cause of all of this? And of course, politics is going to be involved in all of this as well. It's going to take a while to sort out what the facts are beside this. But anytime we go through something like this, let's face it, regulation gets put into place. We're very clever at finding out, okay, given the current regulation, how can I push the limits on the new existing legislation? One always finds ways to be creative. And sometimes those are new cracks that appear that need to be filled. But this is just speculation at this point, Michael. I think that there's a lot of dust up in the air right now. It's going to need to settle. Things are going to need to be studied. And unfortunately, we would love these things to happen instantly. None of this is instant. It takes a while for things to get put into place. Job one at the moment is just to assess the situation quickly, understand the extent of it, prevent the spread, and move on.
Peter, as always, great speaking with you. Thank you for your time and insight today.
Always a pleasure, Michael.
Peter Hall is a senior advisor at Elevate. Still to come from the C.D. Howe Institute, a roundtable luncheon at the National Club with the Honourable Doug Ford, Premier of Ontario. That's March 24th. On April 13th at the Yonge Street headquarters, a roundtable luncheon on the importance of sound mortgage underwriting with the Assistant Superintendent of Policy, Innovation and Stakeholder Affairs at the Office of the Superintendent of Financial Institutions Canada. I'm Michael Hainsworth. Thanks for joining us.
You've been listening to the C.D. Howe Institute Podcast with Michael Hainsworth. Subscribe on iTunes, Google Play, and Spotify. The C.D. Howe Institute is an independent, not-for-profit research institute whose mission is to raise living standards by fostering economically sound public policies. The Institute is widely considered to be Canada's most influential think tank and a trusted source of essential policy intelligence, distinguished by nonpartisan, evidence-based research and subject to definitive expert review. Visit cdhow.org and follow us on Twitter and LinkedIn. Thank you.